Understanding how tax brackets work is essential for anyone looking to take control of their personal finances. Tax brackets are essentially ranges of income that are taxed at different rates. They play a crucial role in determining how much you owe to the government each year. By grasping the concept of tax brackets, you can make informed decisions about your income, investments, and deductions, ultimately leading to better financial outcomes. In this video, we'll break down the intricacies of tax brackets in a way that's easy to understand and engaging. We'll explore how these brackets can impact your overall tax liability and why knowing where you fall within them is vital for effective financial planning. Whether you're a seasoned taxpayer or just starting out, understanding tax brackets can help you strategize your finances, maximize your deductions, and potentially save money. So, let's dive in and demystify the world of tax brackets together. Tax brackets are defined ranges of income that determine the rate at which your income is taxed. They are a fundamental part of the progressive taxation system, which means that as your income increases, the rate at which you are taxed also rises. This system is designed to ensure that those who earn more contribute a larger percentage of their income in taxes, promoting fairness in the tax code. Each tax bracket corresponds to a specific income range, and within these ranges, different tax rates apply. For example, you might find that the first $10,000 of your income is taxed at a lower rate, while income above that threshold is taxed at a higher rate. It's important to note that only the income within each bracket is taxed at that bracket's rate, not your entire income. Understanding how tax brackets work is crucial because they directly affect the amount of tax you owe. By knowing where you fall within these brackets, you can make smarter financial decisions and potentially reduce your tax burden. Tax brackets are influenced by a variety of factors, primarily shaped by government policy and economic conditions. Lawmakers periodically review and adjust tax brackets to reflect the nation's economic health and fiscal needs. For instance, during times of economic growth, governments may choose to increase tax rates or adjust brackets to generate more revenue for public services. Inflation also plays a significant role in determining tax bracket thresholds. As the cost of living rises, the income levels that define each bracket may need to be adjusted. This prevents bracket creep, which is where taxpayers find themselves in higher tax brackets simply due to inflation, rather than an actual increase in real income. Annual adjustments to tax brackets are crucial for maintaining fairness in the tax system. These adjustments ensure that tax brackets remain relevant and equitable over time, allowing taxpayers to keep more of their income in line with changing economic conditions. Understanding these factors can help you navigate your financial planning more effectively. Marginal tax rates refer to the rate at which your last dollar of income is taxed within a specific tax bracket. This concept is crucial for understanding how taxes work, as it differs from the effective tax rate, which is the average rate you pay on your total income after deductions and credits. While your effective tax rate might be lower, your marginal tax rate reflects the tax rate applied to your highest income level. For example, if you fall into a tax bracket where income between $40,000 and $85,000 is taxed at 22%, only the income within that range is taxed at that rate. If you earn $50,000, the first $40,000 might be taxed at lower rates, while the remaining $10,000 is taxed at 22%. Understanding marginal rates is essential because they directly impact your overall tax liability. As your income increases, knowing how much additional tax you'll owe on that extra income can help you make informed financial decisions, such as whether to take on additional work or investments. There are several common misconceptions about tax brackets that can lead to confusion and anxiety about personal finances. One prevalent myth is that earning more money always results in paying more taxes. While it's true that higher income can place you in a higher tax bracket, only the income within that bracket is taxed at the higher rate. This means that your overall tax burden may not increase as dramatically as you might think. Another misconception is that tax credits and deductions don't play a significant role in determining how much tax you owe. In reality, these tools can substantially reduce your taxable income, leading to lower taxes owed regardless of your tax bracket. For instance, a well-placed deduction can keep you in a lower bracket or reduce your overall tax liability. Lastly, many people view tax brackets as punitive, believing that higher rates are unfair. However, tax brackets are designed to ensure that those with greater financial means contribute a fair share, promoting a more equitable tax system. Understanding these myths can empower you to navigate your finances more effectively. Managing your income effectively can significantly optimize your tax bracket outcomes, making tax planning an essential part of your financial strategy. One key aspect is timing your income. For instance, if you anticipate a higher income next year, consider deferring some income or bonuses to the following year to stay in a lower tax bracket. Another effective strategy is tax loss harvesting, which involves selling investments at a loss to offset capital gains. This can help reduce your taxable income and keep you in a more favorable tax bracket. Additionally, maximizing contributions to retirement accounts like a 401k or IRA can lower your taxable income, allowing you to save for the future while potentially reducing your tax burden. While these strategies can be beneficial, it's crucial to consult with tax professionals for personalized advice tailored to your unique financial situation. They can help you navigate the complexities of tax laws and develop a plan that aligns with your financial goals, ensuring you make the most of your income while minimizing taxes. In summary, understanding tax brackets is crucial for maintaining your financial health. By grasping how tax brackets work, including the concepts of marginal tax rates and effective tax rates, you can make informed decisions that impact your overall tax liability. Recognizing the role of government policy, inflation, and annual adjustments helps you stay aware of how these factors influence your financial situation. We've also discussed practical strategies for managing your income to optimize tax outcomes, such as tax loss harvesting and maximizing retirement contributions. By applying this knowledge to your financial planning, you can navigate the complexities of the tax system more effectively and potentially save money. If you found this information helpful, we encourage you to subscribe to our channel, like this video, and share it with others who may benefit from these insights. Your engagement helps us create more valuable content to empower you on your financial journey. Thank you for watching, and we look forward to bringing you more financial tips and strategies in the future.